Patrick Adams, and in this week's Market Minute, we want to discuss some of the things going on in the biotech space that we're involved in, and one particular name that we think has significant upside this year as it'll likely get approved sometime in August. But first, a little review of what's going on in the overall stock market. The inflation report, the PCE, was reported on Friday. It was hotter than expected. And what occurred was, as a result of the higher than expected inflation rate, the federal funds rate moved up from roughly 4.9% over the last several weeks in terms of expectations of where the federal funds rate will peak to roughly 5.4. Now that 5.4 is in line where the bears were. So the bears decided, because of the hotter than expected inflation, that maybe the Fed funds rate will go to 6. We think that's a little too high. And also the 10-year treasuries followed the Fed funds rate futures up a little bit and is now just under 4%, where it was 3.4% about 3 weeks ago. 3.4% 3 weeks ago. So you can see the green line here. This is where the expectations of the bears are, that inflation is going to reaccelerate. And the base case is that inflation will roughly go sideways and then begin to roll over. The stock market, looking at the earnings expectations, they've come down a lot. That's good. So this year's earnings, roughly 223 for 2023, is about equal to what they were last year at roughly 220 in earnings. So basically flat this year, so roughly right now, and we think that they'll likely, as we go through the year, in the first quarter earnings reports and second quarter reports, they'll likely go down another 5 to 10% to be down close to $200 per share. So we think that the market's going to likely struggle because of that. Earnings growth turning negative, valuations having to decline because of the higher interest rates. It's going to be real tough for the market to have any sort of strong move until all this is resolved, and likely the market to go lower. The 249 for next year, we think it's going to be a positive number versus 2023, but highly likely not 249, maybe $230 or $235 in terms of earnings per share. The technicals, however, the technicals are positive. The fundamentals are negative. The technicals are positive, but we're losing momentum. As you can see here, the market has rolled over, down roughly 5% from its peak, recent peak. It broke the 20-day moving average, and now it's broke the 50-day, and it's right on top of the 200-day. So if it breaks through the 200-day, obviously everything will turn negative again in terms of the technicals. But right now, still above the 200-day moving average. And because we are in an oversold condition, down roughly 5% from the recent high into an oversold condition, the bears are now more than the bulls in terms of numbers. So we think it's probably likely that the market will bounce before it ultimately goes over later in the second quarter or sooner. Economic data. So coming out this week, there's two interesting reports. One, the Purchasing Managers Index on the manufacturing sector, and then later in the week on Friday, sorry for a typo, on March 3rd, Friday, March 3rd, you'll see the services sector PMI. Now, we think that these are very reliable indicators of what's going on in the economy. And I wanted to go through this table a little bit with you. So you can see this is the inflation part, or the wages part of the services sector PMI report. It's important because of the size of the services sector. It's obviously a very large part of the overall economy at almost 80%. And you can see the trend here. It's weakening a little bit in terms of prices. So the trend of higher prices being paid is weakening. and so the index on prices paid in the services area is weakening, but it's still at a very elevated level. So this will be the key part of the report on Friday, or the key part of the report for the whole week. So the key report for the whole week. So we'll be watching this very closely, and obviously so will the market and the Federal Reserve. A disappointing number will likely push interest rates up a little bit more on the 10-year Treasury and cause the valuations to contract a little bit. Okay, so what's going on in the biotech for us anyway? So if you viewed our biotech video of about a month or so ago, we like the biotech space, in particular the microcaps, the very small ones. They have been decimated the last 2 years. They're set up for a massive rally at some point. So this is a company, Windtree Therapeutics, that committed the ultimate sin in biotech. They ran out of money. They still have some money, but they essentially don't have enough money to complete their clinical trial. They have 2 cardio drugs. They look terrific. The data on it's very good, but again, they're out of money. They announced last week that they sold $1 million worth of shares and warrants, and you can see down here at $7. This is post the reverse split. At $7, the stock ran to, gosh, I don't know, almost $17, $18 per share. We sold it right around the $16 level, so over 100% gain in one day. We think what's happening, as you can see, it's come all the way back down, right? All the way back down to where it was, that they are going to issue more shares. So they did this reverse split to get the stock high enough to do a stock offering in it. And so once that occurs, we'll repurchase it. So don't buy it now. If you're thinking about doing that, wait till they have their stock issuance, and it'll likely be at a lower valuation or lower price than it is currently. Viking Therapeutics. This is one of our biggest positions. We really like the technology here. It's performed terrific for us. It's a play on NASH. We bought it in the $2 range a while back, and it stocks over 11. So we have roughly a 4.5 times return on our money. So the stock's becoming a little bit too big of a position for us. So what we did, we trimmed it back last week. Macrogill is another NASH company. They're a little ahead of Viking in terms of their approval process. The drug looks good enough to get it approved. That's why Viking's moved up, because of the prospects for Macrogill. Now, we think that Viking has a better drug than Macrogill, and Macrogill at $5 billion market cap and Viking at roughly $1 billion market cap. There's an umbrella there for Viking to move up into to be a similarly valued company over time. So again, we trimmed it back, but love the company, and it's one of our largest positions. Outlook Therapeutics. This is our new buy idea. So we've owned a little bit this in the past, or had some in the portfolio, but this is a replacement for the drug that the compounding pharmacies are producing to patients for wet AMD. So what that means is the purity of this drug's not maybe all that good, because it's coming from the compounding pharmacies. It's not on patent, so there is no FDA approved drug for this particular replacement for what the pharmacies are producing. So this is a pretty large compounding pharmacy product. So there's roughly about $1 billion that Outlook will replace as soon as their drug is on the market. So it might take a while to get all that market share, but the compounding pharmacies will not be allowed to produce that drug anymore. So we see, the stock at less than 300 billion market cap going up at least 100%, so $1 to $2, if not significantly higher, after the drug is approved in late August of this year. So to us, this is a low risk, if there ever was one in biotech. So biotechs are high risk, but a low risk in terms of getting approval and then already having that market in place. We thank you for your attention as always. And if you want to get Mark in a minute, go to my website, Patrick Adams CFA, and send us a message off the website. Please subscribe and please hit like. Take care.